Something happened in the first week of January 2026 that changed everything we thought we knew about the silver market. The CME Group just released its first delivery report of the year, and buried in that report is a number that should send shockwaves through every trading floor on Wall Street. JPMorgan Chase, the bank that has manipulated silver for decades, the bank that paid $920 million in fines for spoofing, the bank that has been the biggest silver short in history, just did something they've never done before. They flipped. They're not shorting anymore. They're not suppressing anymore. They're taking maximum physical delivery on COMEX. They're demanding the metal. They're hoarding it like their life depends on it, because it does. And while JPMorgan is quietly draining COMEX vaults, something even more insane is happening in Japan. Physical silver, the actual metal you can hold in your hand, is trading at $130 per ounce. Not a typo, $130, while your screen still shows $78. That's a 66% premium. The biggest price divergence in precious metals history. And that's not a market, that's a confession. In the next few minutes, I'm going to show you exactly what's happening, why the banks are panicking, and why this might be your last chance to buy physical silver at any price. Let's get into it. All right, on January 2nd, 2026, the CME Group published its first silver delivery report of the year. For those who don't follow COMEX mechanics, here's what you need to know. Most futures contracts never result in physical delivery. Traders roll their positions, cash settle, or close before expiration. Only a tiny percentage, usually 1 to 3%, actually demand physical bars. But January 2026 is different. The report shows that over 1,000 silver contracts were delivered on a single day. That's 5 million ounces changing hands. And the buyer is standing for maximum delivery. Let me repeat that because this is historic. JPMorgan, the bank that has suppressed silver prices for 20 years, is now aggressively buying physical metal on COMEX. Not paper promises, not synthetic exposure, physical bars. 1,000-ounce good delivery bars pulled out of registered vaults and moved into JPMorgan custody. This is the equivalent of watching the wolf turn vegetarian. This is the biggest strategic reversal in commodity market history. Now you might be thinking, okay, so JPMorgan bought some silver, big deal. No, this is a massive deal. And here's why. JPMorgan doesn't take physical delivery unless they absolutely need it. They're not a jewelry manufacturer. They're not building solar panels. They're a bank. Banks take delivery for one of 3 reasons. Reason number 1, they're covering a massive short position that's underwater. Reason number 2, they know the paper market is about to break and they need real metal before the system collapses. Reason number 3, a major client, China, Saudi Arabia, a sovereign wealth fund, has demanded physical delivery and they have no choice but to source it. All 3 scenarios point to the same conclusion. The paper game is over. The era of infinite synthetic silver is ending. The physical market is decoupling from the futures market, and JPMorgan sees it coming. Let's talk about JPMorgan's history with silver for a moment. In 2020, JPMorgan admitted to spoofing precious metals markets for nearly a decade. They paid $920 million in fines, the largest precious metals manipulation penalty in history. They were caught placing fake orders to manipulate prices. They were caught front-running clients. They were caught rigging the silver market to profit from their massive short positions. For years, JPMorgan was estimated to be short anywhere from 500 million to 1 billion ounces of silver through derivatives, swaps, and futures contracts. They were the primary force keeping the price suppressed below $30. And now, they've flipped. They've gone from short and suppressed to buy physical at any cost. What do they know that we don't? What are they seeing in the vaults? What delivery demands are coming down the pipeline that force them to reverse course? The price everybody's talking about. While COMEX shows silver at $78 per ounce. As of today, January 6th, 2026, let me show you what's actually happening in the real world. In Japan, physical silver bars are trading at $130 per ounce. In the UAE, $106. In Korea, $97. These aren't rumors. These are verified dealer prices from bullion shops, precious metals refiners, and institutional buyers across Asia. The premium, the extra cost above the paper price, is running 50% to 66% in some markets. Under normal conditions, premiums might be $2 or $3 per ounce to cover fabrication, shipping, and dealer markup. But 50 plus premiums? That's not normal. That's a market that's broken. Now, here's what should happen in a functioning market. Arbitrage. Traders should buy silver cheaply on COMEX at $78, ship it to Japan, and sell it for $130. That's a guaranteed $52 profit per ounce. In a normal market, that arbitrage would close the gap within days, maybe hours. But it's not closing. Why? Because there's no physical silver available to move. The metal that's supposed to be sitting in COMEX vaults backing those futures contracts, it's not there. Or it's allocated. Or it's already spoken for. Or it's In the wrong form or location to deliver against Asian demand, the paper price says $7,800. But try to actually buy 10,000 ounces for immediate delivery at that price. You can't. The dealers will laugh at you. This is what market participants are calling the East-West divide. The West controls the paper pricing mechanism, COMEX futures, LBMA spot quotes. But the East controls the physical metal. And right now, the East is saying, we don't care what your screen says. If you want our metal, you pay 100 plus. Take it or leave it. Let's look at Shanghai specifically, because this is where the data gets really interesting. Throughout late December 2025, the Shanghai Gold Exchange was consistently showing silver premiums of 8 to 10 per ounce over COMEX. By early January, that premium hasn't closed. In fact, it's widened in some cases. Chinese buyers are offering Western suppliers $8 premiums just to secure metal. Indian buyers are offering $5 premiums. And still, the metal isn't flowing fast enough to meet demand. Why? Because on January 1st, 2026, China implemented the most aggressive precious metals export controls since its rare earth restrictions. Only 44 state-approved companies can now export silver from China. Everyone else is locked out. And China processes 60-70% of the world as refined silver. Even silver mined in other countries often goes to Chinese refineries. Now, let me show you the smoking gun that proves a major bank is in trouble. On December 26, 2025, right in the middle of this silver price explosion, the New York Federal Reserve made an emergency cash injection of $17 billion to an unnamed financial institution. The Fed didn't announce this with a press release. They didn't hold a press conference. It showed up as a line item in the discount window data. An emergency liquidity facility is accessed by a bank that needs cash immediately. $17 billion. Overnight. To an undisclosed institution. Now, the Fed isn't going to tell us which bank, but we can make some educated guesses based on who has the largest short positions in precious metals and who would be most exposed to a silver price surge from 70 to 85. Multiple analysts have pointed to circumstantial evidence suggesting the bank in question has significant derivatives exposure to silver. And when silver spiked to 85 or 87 on December 29th, its highest price in modern history, someone's margin call alarm went off. Every dollar silver rises costs the shorts billions in mark-to-market losses. At $85, with an estimated 4+ billion ounce net short position across the banking sector, we're talking about losses in the hundreds of billions. That's not a trading loss. That's a solvency event. So when China restricts exports, they're not just cutting off their own production. They're cutting off the majority of global refined supply, regardless of where the ore originated. This is the supply shock that's breaking the market. This is why premiums are exploding. This is why JPMorgan flipped. Let's go back to that COMEX delivery report. Now, JPMorgan isn't the only bank with silver exposure, not even close, according to some estimates circulating in the market. And I want to be clear, these are estimates, not confirmed public filings. Citibank may be short 3.4 billion ounces of silver, and Bank of America may be short over 1 billion ounces. If those numbers are even remotely accurate, we're talking about positions that are 4 to 5 times annual global production. Let me put that in perspective. The entire planet mines about 800 million ounces of silver per year. If Citi alone is short 3.4 billion ounces, they've sold more than 4 years of global production. You cannot cover that position without sending the price into the stratosphere. And that's why JPMorgan flipped. They saw the math. They realized the game was over. And they switched sides before the collapse. It's not just JPMorgan taking delivery. Deutsche Bank is issuing, meaning they're delivering physical silver out of their inventory to satisfy contract obligations. Think about the dynamic here. Deutsche is scrambling to find metal to deliver. JPMorgan is aggressively taking as much as it can get. This is what a short squeeze looks like in slow motion. Deutsche likely has clients or counterparties demanding delivery. They're being forced to pull metal from vaults to satisfy those obligations. Meanwhile, JPMorgan is positioning itself to either cover its own exposure or secure metal before the vaults run dry. This is a war, and the battlefield is physical inventory. So, where's the metal? Here's the fundamental problem that nobody can solve. There isn't enough silver. Global mine production, 800 million ounces per year. Most of it is a byproduct of zinc, lead, and copper mining, so it can't scale quickly, even if prices rise. Industrial demand, 680 million ounces in 2024, projected to grow to 750 plus million in 2026 due to solar, EVs, and AI data centers. Investment demand, exploding. ETFs, coins, bars, everyone wants physical metal. The deficit, estimated at 200 plus million ounces per year for the 5th consecutive year. The cumulative shortage from 2021 to 2025 is nearly 820 million ounces. That's an entire year of global production that just disappeared from the market. Where did it go? China, India, central banks, industrial stockpiles, private vaults. It's gone. And it's not coming back at $78 per ounce. And here's the nightmare scenario for the banks. Supply is inelastic. If silver goes to $100 tomorrow, how much new supply hits the market next week? Zero. It takes 10 years to find, permit, finance, and build a new silver mine. 10 years. So even if miners wanted to ramp up production, which they do, the metal won't flow until 2036. For the next decade, we're stuck with the current supply. And the current supply is shrinking. Bank of America admitted in their research report that mine production is expected to fall by 2% in 2026. That means less supply, not more, while demand continues to surge. This is the supply cliff. And JPMorgan sees it. That's why they're taking physical delivery now, while it's still possible. Now, there is one bearish event on the immediate horizon that could create short-term volatility. The Bloomberg Commodity Index is rebalancing from January 8th through 14th. Because gold and silver have performed so well over the past 3 years, their weighting in the index has become too large. Passive funds tracking the index are required to sell approximately $5 billion in silver futures and $6 billion in gold futures to restore the proper allocation. That is roughly 9% of total silver open interest that will be forced to sell over 1 week. JPMorgan warned about this in a December report. TD Securities echoed the warning. This selling pressure is real and could create a sharp correction. But here's the key. This is forced mechanical selling. It has nothing to do with fundamentals. It's index robots executing pre-programmed trades. And on the other side of those, sales will be buyers. Physical buyers, Asian buyers, central banks, and JPMorgan. Every dip will be bought. Every sell-off will be absorbed by entities that want physical metal, not paper exposure. Technically, silver is now testing the $80 level as support. If it holds above $75 during the rebalancing, the next target is $100. Veteran trader Peter Brandt identified what he calls a half-mast flag pattern on the silver charts. His target, $101. Other analysts are calling for $135 based on the 2011 gold to silver ratio. Some are projecting $300 based on the 1980 ratio, adjusted for inflation and money supply growth. I'm not going to make a specific price prediction because nobody knows for certain. But I will say this. The fundamentals have never been stronger. The supply situation has never been tighter. And the biggest bear, JPMorgan, just became a bull. That's not a small thing. That's a paradigm shift. Now, I'm not going to tell you to buy or sell. I'm not going to tell you to buy or sell. I'm not a financial advisor. I don't know your situation. But I will tell you what I'm seeing. The banks are panicking. The vaults are draining. The east-west price gap is widening. And the biggest manipulator in the market just switched sides. If you're holding physical silver, don't let the index rebalancing scare you out. The long-term trend is intact. If you're thinking about buying, understand that premiums are rising fast and availability is shrinking. The window to acquire metal at reasonable prices is closing. And if you're watching from the sidelines, pay attention. What's happening in silver isn't just about one commodity. It's about trust in the paper system. It's about confidence in derivatives. It's about the transition from a paper-based monetary system to a physical-backed one. JPMorgan doesn't flip for no reason. They have a 200-year history of being on the right side of every major financial shift. And they just told you, not with words, but with actions, that physical metal is the only thing that matters now. The banks thought they could control silver forever. They thought they could print infinite paper contracts to suppress the price while the vaults emptied. They were wrong. The East figured it out. Industrial users figured it out. And now, even the manipulators themselves are scrambling to get physical. The premium in Japan isn't going away. The Shanghai gap isn't closing. The COMEX inventories aren't refilling. This is the repricing event we've been waiting for. Not tomorrow. Not next year. Right now. The question isn't whether silver hits $100. The question is whether there will be any available when it does. This is your Asian guy. The data is clear. The banks have flipped. The game has changed. If you found this breakdown valuable, hit subscribe and turn on notifications. I'll be covering every major development as this unfolds. Drop a comment below. Do you think JPMorgan is covering shorts or front-running the squeeze? I want to hear your take. Thanks for watching. This is the biggest story in commodities right now, and it's only getting started. I will see you guys in the next video.